Okay, so now, but what are the current ramifications of that?
Well, interesting question. It depends what's going to happen with the property. If you have debt coming due and it's way in excess of the value of the property, you have a couple of choices usually. The first choice is, if you have the liquidity and the wherewithal and the even desire, is you can take money out of your pocket, turn around and pay down the debt to a manageable level of debt, and then the bank walks away happy, and maybe you can refinance the property to a level of debt that makes sense that the property could support at that point. The second possibility is you engage in discussions with the lender, where maybe the lender is going to agree to reduce the value of the debt down to a more manageable level, or maybe they'll agree to defer some payments, or maybe you'll put in a little more equity. All kinds of things could be negotiated with the lender to maybe let you hang on to the property, and you sort of work it out with the lenders, and that's why those are called workouts. And we're going to get a lot deeper into what workouts are and what they mean to a little further on in the discussion or another day. But in the worst case scenario, the owner will look at the property and say, I'm not putting another nickel into this thing, and the bank won't talk to you and negotiate with you. And at that point, you wind up in a foreclosure action.
What is a foreclosure?
Excellent question. People talk about foreclosure all the time. I'm not sure people truly understand what foreclosure really means. In a foreclosure action, the bank or whoever the lien holder is basically comes forward and says, you've defaulted on the mortgage, you're not paying the current debt service, you haven't paid it when it comes due, we're going to go to the court, and we're going to get a judgment that you're in default on that mortgage, and the remedy for that is a public sale of the property. Now, what happens is you get this judgment, and then the judgment is docketed, and then a sale is set forth. And at that sale, which is sometimes on the courthouse steps, people come forward and bid on the property, and very often the high bidder at the property will be the lender. Because the lender has the amount of the mortgage that it can bid in. So if anybody bids less than the current amount of the lien, they can just bid in the amount of the debt, and then they take over the property. And at that point, they are the owner of the property. All the owner's rights and anybody with a junior lien's rights has been extinguished, and the bank takes over the property. Now, banks don't really like to take over properties because they're not in the business of running real estate. They're in the business of, or they used to be in the business of, lending money. But when there is no other remedy, and when that's the only way they can sort of protect the value and get the most for the property, then the banks will do that. They will step in and foreclose and force a sale and typically wind up with the asset.
What are the tax consequences of a foreclosure?
Well, it depends a little bit. Generally, when we're dealing with a non-recourse mortgage, the tax consequence will be a sale of the property for the amount of the mortgage. So, for example, let's say that we have a taxpayer who paid $110 for an asset, and it's burdened by a mortgage of $100. Well, he has a tax basis of $110, and in a non-recourse mortgage, when there's a foreclosure, it will be treated as if he sold that property for $100. Even though he's getting no money, the sale price is $100 for tax purposes because that's the amount of the debt on the property. So for a sale of $100 with a basis of $110, he's going to recognize a loss of $10. Now, generally, that will be an ordinary loss if it's trade or business property. Now, that's for a non-recourse mortgage. For a recourse mortgage, it gets much, much more complicated. In a recourse mortgage, there's actual personal liability. So that if the debt isn't paid, if there's any deficiency between what the property is worth and what they actually get for it, then that deficiency usually has to be paid by the borrower. But let's assume for the purposes of our discussion that the bank just takes the property and forgives the deficiency. So in a recourse mortgage, you bifurcate that transaction into two pieces. It's a sale to the extent of the fair market value of the property, and then any spread between the fair market value and the actual amount of the debt is treated as cancellation of indebtedness income. So let's go back to our prior facts. It's the same facts, paid $110 for the property, except the property's worth only $90, and it's burdened by a debt of $100. So for tax purposes, it's treated as a sale of the property for $90. Now remember, we have a basis of $110, so we have a loss of $20 which generally will be an ordinary loss on the sale of the property. But then there's a second transaction, which is a $10 cancellation of indebtedness transaction. Because the amount of the mortgage of $100 is more than the fair market value of the property, $90, that $10 is treated as cancellation of indebtedness income. Now in our facts right here, where we have a $20 loss and 10 of COD, we net out to the same thing as in the prior example, a net loss of 10. But that won't always be the case, because in certain transactions, especially if there's a gain, you'll wind up with ordinary income and capital gain, and you could wind up with a much worse tax situation.